where we left off last week, we were talking about the video. We watched the video from the Swedish investor about Nassim Taleb's book, Fooled by Randomness. And prior to that, we were talking about event studies. So I want to finish up that discussion, talk a little bit more about informed trading, insider trading, illegal insider trading, and market efficiency in general, and what the data shows, what some of the anomalies are, and that'll wrap up chapter 7. I think we'll have a chance to get into 8 as well. 8's kind of a fun chapter. It's called Behavioral Finance. And I apologize earlier. I had my chapters mixed up. We don't get to Cap M until 11 and 12. So we've got chapter 10 coming up, which is on bonds, and then we'll get into more of the nitty-gritty around Cap M. All right, so event studies. Event studies are one of the most important methods that we use as researchers to try to understand what's going on in the marketplace. And the example that they give you here of an event study, advanced medical optics, I think is a good one to use here as an example. So we've got this company that produces a contact lens solution, and there were possibly some problems. So they found that there was some sort of potential for this lens solution to be correlated with the occurrence of a very rare corona infection. And as a result, the company proactively pulled the lens cleaning solution from the market. So they weren't required to, and in fact the correlation was not proven to be causal, and that's an important difference, right? There's correlation and there's causality. It's easy to find correlation. You run a regression and you can find correlation. It's much more difficult to prove causality. And causality meaning that the lens cleaning solution was causing the occurrence of this rare corona infection, or cornea, sorry, corona? Cornea infection. In any case, so the company pulled its product from the market. The executives said that, hey, we don't really think there is no evidence, not even that we don't think, it's that there is no evidence of this. However, we're doing this as a preventative, as a very abundance of caution measure. So, as a result of this change, on Tuesday, May 29th, the shares opened $5.83 down from the Friday closing price. So here we see a plot of those share prices. And so right here was the announcement, and here was the decline in share prices. And you'll notice another feature of this is that these prices looked like they were relatively stable before and relatively stable after. So this is kind of that prototypical pattern that we were looking for earlier in this chapter, a very efficient response to a new piece of information. Now, the question that the researcher has to ask, though, is how much of this response is actually due to that new information and how much would have occurred anyway. And this is where we come up with this abnormal return. Remember, we defined abnormal return at the very outset of this chapter as a return that was different from what we would expect given the change in the market and the relation between the individual stock and the changes in the market. So what we're looking at here is an observed return minus the expected return. And that expected return is what we would expect if nothing had happened. And if the market was up by 5%, this company's price might have been driven up by some fraction of that market increase, and may have even wiped out the decline as a result of this potential that the lens cleaning solution was causing this cornea infection. So we have to subtract that out before we can actually say something happened here. The expected return is calculated using a market index and using the beta. And that's what they mean by that long-term average return on the stock. We're going to calculate a beta for that stock, and we're going to say the expected return for that stock on that day is a function of the risk-free rate, the beta, and the return on the market that particular day. And we're going to use that to calculate an expected return. We're going to subtract that from the observed return, and we're going to, whatever is left, is an abnormal return for that particular stock. We typically will look at this pattern of abnormal returns over a wide window surrounding the event that we're studying. Now, this particular event, I mean, it's obvious that there's information in this event. It's not always so obvious that that information is unknown to the market prior to the event. So this event was relatively a relatively large shock, whereas we might be studying announcement of earnings or things of that nature. And we know that we're going to get an earnings announcement at some point in time, and we have some expectation of what that might be. So the earnings announcement itself is a much more difficult event to study. This particular event, we can think of it as almost exogenous, coming from outside. It's not truly exogenous potentially, but it's easier to interpret than, say, something like an earnings announcement where we see these every quarter, and they typically do them on the same day, and there's some guidance from the company prior to that. So the impact of the announcement itself is of dubious quality. Now, here we do a plot of those abnormal returns. Now, notice the difference between this chart and the prior one here. This was in price. Now we've actually calculated a daily return, and that's why you see most of these centered around 0. In fact, the very first one will be scaled to 0. And so we see very few deviations from 0. And when we're actually doing this sort of study, we would get some sort of bounds based upon standard deviation, and it could be that anything within these boundaries is not significantly different from 0. So this is a fairly typical pattern. Now we do see some fairly big negative abnormal returns here, and then again we see it stabilizing. Although, and this is the problem with ocular statistics, it sort of looks like there's a bigger variation than what we saw up here. Now that may or may not be real. Always be careful whenever you're looking at a plot. If somebody's presenting you a picture of a plot, more than likely they want you to see something there. That's why they're giving you that picture. And if we see something here, but it may not have any real meaning, that could be problematic. So always be a little skeptical of what I call ocular statistics. Just looking at that picture doesn't necessarily tell us the entire story. So here we see that the cumulative abnormal return hovers around 0 before the announcement. Then there's a sharp downward decline, and then it stabilizes back again at 0. So overall, this is what we would expect out of an efficient response. And so this could be evidence that markets are efficient, that they react quickly to the new information. Notice there is not any obvious pattern of overreaction, which would be like this, or underreaction, which would be more like this. Looks like it pretty well goes straight down and then levels back out. So that's a typical study, and we do these with various types of events. Like I say, some of them are more exogenous than others. Exogeneity is an important criteria, though. If you have an event that is expected, or that is by the choice of the company, that becomes more problematic, and you have to deal with those endogenous issues. That is, the decision to make a particular announcement may be related to the outcome that we observe, right? That's endogeneity. An exogenous shock is an asteroid hitting the planet. We didn't know it was coming until a day before it hit the planet, and it had this effect on a whole bunch of different things. That's very exogenous. We had no control over it. We didn't get to choose it. Now, another type of less extreme exogenous type of effect could be maybe you're studying companies and the federal government makes a decision to change the interest rates. Now, that is usually viewed as largely exogenous, although there could even still be some sort of endogeneity connection in there. But that's an important takeaway from this. These studies need to, the event needs to be an exogenous shock to the system in order for us to have any credible belief that what we're observing is what we should be observing if markets are efficient. All right, so now we come to a more nuanced question here about informed and insider trading, and in particular, what is legal insider trading and what is illegal insider trading. So we have a number of different definitions. In the US, it's illegal to make profits on non-public material information. That is illegal. So if I'm an insider and I know something that nobody else knows or just other insiders know, and I make a trade on that basis, then I could fully expect the SEC to be knocking at my door, or the FBI, whoever actually prosecutes that. If I wait until that information is made material, or excuse me, if I wait until that information is made public and the stock price has reacted already to it, then I can make a trade. So here we're talking about the time that I want to make a trade is when there is less information asymmetry. Now, by asymmetry, I mean that one party is better informed than another. And here we're assuming the insiders are better informed than the rest of the marketplace. And once I remove that asymmetry, once the marketplace is just as well informed as the insiders, I have very little asymmetric information. That's the time that as an insider, I want to trade. So most insiders are cognizant of this. They don't want any appearance of illegal insider trading, much less being persecuted for that sort of thing or prosecuted. So they'll wait until information is made public, especially around these events. So I was talking about earnings reports, earnings announcements. So if you're an insider, you don't want to buy or sell right before an earnings announcement. That would look very suspicious, especially if you were buying a bunch of stock and the earnings announcement just happened to be a really good positive event and caused the stock price to go up right away. That would look pretty suspicious, right? Now, if you were selling at that point, maybe less so. But even at that, you don't want any sort of potential confusion that you are trading when there's a great deal of asymmetric information between the insiders and the marketplace. Now, your text talks about informed trading, legal insider trading, and illegal insider trading. And to that list of three, I'm going to add a fourth, and that is illegal insider trading that cannot be prosecuted. All right. So informed trading is simply that a trader knows something about the company. They've used publicly available information to do an analysis, not unlike what we're doing with the Sprouts Farmers Market, and we've studied it intensely. We've dissected the entire company, learned how it works, how it generates profit, how it competes with its comparators, and then we make a determination as to whether it is fairly priced, overpriced, or underpriced, and then make a recommendation on that basis. So we're looking at Wall Street Journal, we're looking at reports. We're looking at other financial information. We're even talking to other investors, i.e. other analysts that follow this company. We're talking to executives if we happen to be on an analyst call or an earnings call. So that's informed trading. Now, insiders often trade, and most of the time they are trading and it's quite legal. So just because you hear the word insider trading doesn't mean it's illegal. In fact, most insider trading is quite legal, and insiders are very careful about that. So when is it not illegal? Company insiders can perfectly legally trade. They have to follow the rules set out by the SEC. So they have to follow a set of reporting requirements. So this takes the form of Forms 3, 4, and 5 are the forms that we would see when an insider makes a trade. There's some requirements in terms of when that gets filed. They continually tighten up the constraints on insider trading. It used to be you could report these a month after you made a trade, depending upon when you made that trade in the reporting cycle. Now it's within a few days. So, and that information becomes public very quickly. And that's always a good thing. Another example here. Let me show you one of these forms. So here is a form filed by Tim Cook of Apple, of course. And this is showing that Tim was granted some restricted stock units or shares. And on September 27th, 2020, this was an acquisition, so that's why we see the A code in there, of 333,987 shares. Exercisable date, well, what is it? It's got a footnote down here, so it says, these restricted stock units are scheduled to vest as to 1/3 of the units on each of April 1, 23, April 1, 24, and April 1, 25. What's vesting? It simply means that at that point in time, Tim Cook actually has the right to do something with those shares. So these 333,987 shares, they're sitting over right now in a pile, and they've got Tim's name on it, but Tim can't do anything with that pile of shares. Now, April 1, 23 comes around, and if he meets certain performance criteria, and that's described down here in footnote 3, he will actually be allocated out of that pile so many of those shares. And that allocation, based upon this little footnote here, I won't read it all to you, but basically it says, depending upon how Apple stock performs, he'll get anywhere from 0 of those shares up to 200% of the shares. So that's why you actually see a second entry here for an additional 333,987. That's that extra. If the company's stock performs really well, he'll get double the amount that he was just granted. If it doesn't perform anywhere near as well, he'll get nothing or something in between. So he'll get however the company performed, he'll get 1/3 of that. And then he'll be able to sell those shares. But up until that time, they're just set aside for him. All right. So this gives you a lot of good information about what's happening, who's doing what. At some point, you'll see that he would actually have disposed of these shares. So if we looked at sometime after April 1 of 2023, we'll see what Tim Cook does with them. He could hold them, or he could actually sell them and buy other shares, or you could just sell them for cash. But these forms get filed all the time, and you can go to the SEC's EDGAR's site, the Electronic Data Gathering and Retrieval database that they support, and find all of these forms. All right. Let's see. Okay, the typical case of insider trading, illegal insider trading that is based upon commission. So that means I do something. commission means I actively do something. Omission is different. Omission says I failed to do something. And that's where this fourth category that I posed to you comes into play. The act of omission, the failure to buy or sell. Let me show you a chart here. This is out of a paper that myself and Dr. Devos and Dr. War published a few years back. We were studying executive compensation and stock option grants around the time of a stock split announcement. So this day zero point right here, that day zero is the day of the stock split announcement. So the board of directors met sometime back here a few days ago. Usually it was 2 or 3 days prior to the announcement of the split. And the board made 2 decisions on that day. One was to actually split the company's stock. And the second was how much they were going to grant to their executives in terms of stock options. All right? So what this chart shows you is what the executives are doing in terms of their trading activity. All right? So the light gray are sells, the dark gray are buys. And you'll notice that the buys amount to very small, at least relative to the sells, very small amounts. So we pretty much ignore that. Think about it this way. If you're an executive in any of the S&P 500 type companies, you're getting grants of shares of stock as well as options on company stock. So your typical move is to sell. More than likely, you're not out buying your own company stock because so much of it is coming in the form of compensation. So your typical position is to be selling that stock. So that's not unusual. So that's why we see many more sells than we see buys. The pattern that I want to point out to you, though, is that back here, or maybe even further back, or maybe even way back here, the executives knew something that you and I did not know. And that is that more than likely the board is going to approve the stock split. Why? Well, because we've had stock splits for the last 5 or 10 years. And they typically approve them. You know, you can see this pattern in companies that do stock splits. The price will go up, they'll split it back down, price will go up, they'll split it back down. So we can predict for at least weeks before the actual announcement that we're going to do a stock split. So is there anything strange that you see about this pattern then, in light of that information? Anything that makes you wonder, is there something going on here? What if you wanted to, buy that new Mercedes-Benz or that new yacht, or you're getting ready to upgrade your house? You needed some cash. And we knew back here sometime that we needed that cash. But we also knew that the company was likely to split its stock very shortly. When would you sell? Oh, wait a minute. What's a stock split announcement do to the share price typically? What's the on average response? Yeah, Zachary, I see you pointing up. Anybody know how much up? 2.5% to 3%, 3.5%. Depending on the period, it varies. That's a pretty substantial bump up for one day. This is one day. Other studies look at 3-day, day -1 to day +1. Some still look at day -2 to day +2. But whichever window you pick, you're somewhere in that 2, 2.5, 3, 3.5 range. And this is, remember, this is abnormal. This is not what you would normally expect. This is directly related to the announcement that we're doing a stock split. Now, the question of why that is the case, why when you hand me a dollar bill and I give you two 50-cent pieces, why people think that that's good news, that's a whole different story. But we've got documentation that around 3/4 of the stock split announcements are non-zero positive return events. That also raises yet another interesting question. What about those 25% that announce and it actually causes a decline in the share price? That's puzzling too. But still, 3/4, it's pretty good odds. So if you needed some cash and you had a pile of company shares sitting in your account and they were vested, which means that you could then sell them, when are you going to sell them? Before or after the stock split announcement?
Right after.
Yeah. I would argue right after. In fact, look at this data. Here are the trades. This just is number of trades. It's not shares traded. If we looked at it as shares traded, we see the same pattern. But number of trades around 40-ish on a daily basis. Boom, all of a sudden pops up to 2.5 times that on the couple of days following the stock split announcement. Is this illegal insider trading? That's the question. And could I even prove it if I were to say it was? That's an even tougher question to answer. I think the answer to that question is probably not, unless we could get inside somebody's head and see everything that they were thinking about, knowing that they were thinking about buying that yacht or that car back here and said, well, wait a minute, I'm going to hold off till after the announcement because I'll get 3% more for my shares when I sell them. The other thing going against anybody trying to prosecute an insider for this as illegal trading is that when is information more symmetric between insiders and the market? Right there, right? The announcement removes that asymmetry. Now that non-public material information has been made public. And they're trading when information asymmetry is at an all-time low. So how could you ever prosecute something like that? So here's an interesting quasi-illegal-ish, I don't know if we want to call it that even, but certainly it looks like executives are behaving as though they are putting off their trades until after this event. Now, we could even argue that not only is it not immoral or illegal, but it also is actually good for the market that executives do trade when they have inside information because it is more quickly impounded into the share price. And this is an issue of relevance to the overall economy and a discussion and something that we should continually think about. What we're doing here is balancing the idea of market efficiency with how confident are investors in the marketplace. We want to maintain confidence in the marketplace too. We don't want investors to think, oh, it's an insider's game, I'm not going to put my money into that, because insiders are going to win every time. So as a society, we put laws that prohibit that sort of activity, but that harms market efficiency. That slows down the process where information gets impounded into price. But we're okay with that trade-off because that builds up confidence in the rest of the society that, hey, yeah, we'll put our money into the marketplace and we'll put it to its highest and best use and get the most return out of it, which will help grow our economy. So I want you to, I always, any of these issues that we're dealing with, um, I always want you to think back to the bigger picture. Think back to, is it overall good or bad for society? And are we balancing a couple of things here? Because there is no easy black and white answer. Most of these answers are very much in the gray zone. So I always want you to consider that sort of thinking. Should we prosecute people for this sort of trading behavior? In my opinion, no, it'd be silly. Should we loosen up the constraints on what we now call illegal insider trading? That's an entirely different question, and it's one for society to struggle with and decide which is more important. Getting more money into the marketplace so that that money can help grow the economy, increase the number of jobs, increase our economic output, et cetera, et cetera. Now, you can debate on how much that will cause that sort of thing and what the costs are to market efficiency, et cetera, et cetera. But that's the sort of discussion we should continually think about as we make these decisions. All right. Questions about that? Okay. Are markets efficient? And by what degree do we measure that? Well, here's some evidence about that. We'll start off with the fact that, stock markets are one of the most extensively documented and studied events or activities of human endeavors. This NYSE TAQ database, TAQ, Trade and Quote database. It used to be, when I started my PhD program at University of Arizona back in 1992, I remember getting a CD. Do you all know what CDs are? Compact discs, right? They've kind of gone the way of vinyl. Now, vinyl is making a resurgence in kind of a niche category, but you get my point. They sent out a sample CD of 1 month of trades on the NYSE. And this was a single-sided CD. That was the entirety of the trade and quote data for 1 month on the NYSE of all stocks listed, all 3,000 some stocks listed on the NYSE. Today, that same CD, what was it, 600 megabits? I don't know if my memory on that, a normal density CD, one-sided, somewhere in that vicinity, I believe. Now, that probably wouldn't even hold 5 minutes worth of data, much less an entire month's worth of data. So we have just an extensive amount of data coming to us. And now we're getting data from the NASDAQ and every other exchange that's included on that. So lots of data to pour over. They've been exhaustively tested by people like myself, researchers that go out, have this idea, hey, here's an interesting event. Why don't I look at how the market reacts to this event? And let's see if it corresponds with market efficiency or not. That's the kind of test. So remember, the whole scientific process is somebody posits a hypothesis. They say that and this is usually built up from years of experience and anecdotes, but then they posit this, here's a model, here's an ideal. And then the rest of us all go out and we look at the data and we say, how closely does the data correspond with this ideal model? And the more data that supports that ideal model, the stronger support we have for that as a viable and good theory, a model that represents what's actually happening in the real world. Now, there's some problems with those sorts of empirical studies, and those problems are listed here. We have a risk adjustment problem, we have a relevant information problem, we have a dumb luck problem, and we have a data snooping problem. Now, the risk adjustment problem is related to CAPM. So if we pick one stock and we compare it to another stock, and we say, well, this one stock is performing better than the other stock, what have we missed? Would you pick stocks on that basis? Probably not, right? Because you want to know how risky is that stock. So we know that there's a high correlation between risk and return. So if I just randomly pick two stocks, one stock might be riskier, so it's going to look like it has a better return. But when I adjust it on a risk basis, maybe it doesn't have as good, or it's no better on a unit of risk per unit of risk comparative basis. So how do I make that adjustment? Well, I go to my capital asset pricing model. I calculate a beta for that particular stock, and that's how I'm going to calculate the expected return, the return that I think I should be getting based upon how the market does that particular day or week or month. Well, here's the problem. Here's why that's even an issue. How do we know that CAPM is the right model? I think I've mentioned the DGP in the past, the data generating process. We're making an assumption that CAPM is the correct model. And the jury is still out, even though this model has been around for over half a century. The jury is still out on whether CAPM by itself is the right model. In fact, there are many other models that have been proposed since CAPM, even though CAPM is still the most widely used model. I've mentioned to you the Fama-French three-factor model. That's quite widely used now too, but then there are 4 and 5 and 6-factor models out there. So if we use CAPM and assume that's right, maybe we're not correctly adjusting for risk, and what we're observing is a result of that incorrect adjustment, not really an event. All right, so that's the risk adjustment problem. Relevant information. What's relevant information? We can look back in time, and what do they say about hindsight? It's 20/20, right? Yeah. So it's difficult to move ourselves back in time and say, what if we only knew right at this point the information that was available? And when did we know about that information? Is it when the information hit the Dow Jones Newswire? Or is it when the company made some sort of announcement in a press release? Well, we can look that up. We've got documentation of that. But when did the individuals in the marketplace actually receive that information? Now, in today's world with algo trading, that's a lot easier to wash away and say, well, it doesn't really matter because the algos saw it. But back when we didn't have as much algorithmic trading, individuals still had to actually receive that information, process it, and then act on it. So that's the relevant information problem. What information was available at that time? Looking back, it's difficult sometimes to say. The dumb luck problem is obvious. There are, remember, statistics say we have 95% confidence that it's somewhere between these two bounds, right? What about that 5%? There's your dumb luck problem. And then the last issue is what we call data snooping. And data snooping is that the researchers only have one experiment that's been run, and that is our current world. So far as we know, there are not thousands of parallel worlds with which we can study something. So data snooping is looking at the same data until we find a pattern. Last week I showed you that picture of the clouds, right? Human beings are good at pattern recognition. We find patterns even when there aren't patterns. And the idea of data snooping is you keep looking at that same cloud until you see something in it, and then you go, aha, there it is. The 1001 study that finds something, that's the one that gets the press too. The other 1,000, not so much. So that's the data snooping problem. We have one set of data and we have just been exhausting it. I mean, we torture that data to give us an answer. Why? Because I can't get my paper published if I don't have a result, if I don't have a significant statistic. Another very related problem to data snooping is that of researchers who run 100 regressions. And out of those 100 regressions, just by statistical inference, 5 of them are going to come up with significant results. But that's just pure luck. What if I only report those 5? That happens a lot. I can guarantee you that happens a lot. So many problems that you should be cognizant of that temper what we're going to see next, which is all the data that says that markets are efficient and that active management of a portfolio is a waste of time and money. So you've got to always qualify that with, okay, wait a minute. We've got that risk adjustment. We've got that relevant information. We've got the dumb luck. We've got the data snooping issues that all pertain to this, to the empirical evidence that we've gathered here. All right, so the generalities, short-term stock prices and market movements appear to be difficult to predict with any accuracy. The market reacts quickly and sharply to new information. Various studies find little or no evidence that such reactions can be profitably exploited. Otherwise, you probably wouldn't see that many finance academics, right? We'd all be sitting in the Caribbean sipping margaritas. If the market can be beaten, it's not obvious. In other words, those people who actually can beat the market, they're not telling us. They're hiding out, just beating the market, making money. But it's also very difficult to tell how many of those folks have just had a long streak of luck, and it's just a moment from crashing and burning, or if they actually are still beating the market. Now, as I say, we want to qualify some of this, but others, there's so much evidence that, we pretty much, everybody agrees that security selection is much less important than asset allocation. And the studies that find that, 90% of your return is related to which category you put your money into. Is it stocks, bonds, currency, commodities? Only about 10% is related to picking a particular security or set of securities within that broad category. There will be a small role for professional money managers. All right. Meaning that, hey, if I can't really beat the market, we shouldn't have that much actively managed money. Stock picking or even market timing type of strategies. So these things should be probably less prevalent. And that's also an interesting question. Is it because they're so successful, or is it because it's so difficult to tell whether they're successful? Look at the Bernie Madoff issue. He had decades of giving his investors a steady 10% return. People thought he was a genius. Turned out he was just a scam artist. Nobody had caught up with him because he had a reputation that was good to begin with, not so good at the end. So this Darts versus the Pros article ran from the late 80s into all through the 90s. They eventually dropped it, but it wasn't a very good experiment as experiments go, but it did highlight this question about do we need professional money managers and how valuable are they? So the Darts column was a regular feature in the Wall Street Journal, and it pitted 3 money managers against 3 darts. So they paper the wall with the Wall Street Journal. This is back in the days when the quotes were printed at the back of the journal. And so they'd staple those up to the wall, have somebody stand back about 20 feet with a couple of darts and throw darts, and wherever that dart landed, that was the stock. They threw 3 darts, then they got 3 money managers, professional money managers, to pick 3 companies, and then they waited and they compared the returns of those 2 portfolios. Now, and here's why, while it was a fun thing and it drew attention, it wasn't a very good experiment, because the darts were not, we only threw 3 darts, and so the potential of having a diversified portfolio was near 0, and the darts were not risk adjusted, but the money managers could have just picked very risky stocks and gotten lucky, so they might have gotten a high return because of the lack of risk adjustment. So there was none of that going on in this. It was more of a fun column, just to raise the attention and see what would actually happen. So here's a little article about when they retired that column, and it gives you kind of the details of what was done and how it turned out. One thing I wanted to show you, and I don't see it in this particular article, they had a chart. I don't know why it's not in this version of it. When I was online on the in my browser, it did show up. But there is a chart that shows essentially how well the darts did vis-a-vis the managers. And the managers did beat the darts most of the time. So depending upon how you adjusted it and how you compared it, the managers is somewhere in the neighborhood of 2/3 of the time they won, 1/3 of the time the darts won. But if you made an adjustment and you said, well, let's not use the darts, let's use the S&P 500 as the benchmark against the professional money managers, then it got a lot closer to half or 5/8 where the money managers won. So closer to flipping a coin if we compared it to a buy and hold strategy of the broad market. So this, again, while not a perfect experiment, it raised the attention of that issue. Why do we need these folks spending millions of dollars, using thousands of hours of computer time and expertise on picking stocks, when some of the times it was a flip of the coin as to whether they did better than just a buy and hold of the overall broad-based market index? Questions or comments so far? All right. Here's another, again, ocular statistics. Always be wary of this, but let's dig into it a little bit and see what it can tell us. So here we're in the blue, we're looking at total funds on a year-by-year basis. So this dark blue line, you can see, from the 90s, we peaked right before the financial crisis, saw a bit of a dip in it. But still we have, thousands of funds, actively managed equity funds, by the way. So we're even limiting it. If they are bond funds or other types of assets, they're not even included in this count. This dashed blue line is the number of these funds that actually beat what your authors call the Vanguard 500, which is a mutual fund that tracks and has a very, very small tracking error with the S&P 500 index. I don't know why they didn't just say the S&P 500 index, but they didn't. But you get the idea. So we're talking about a broad-based buy and hold strategy, which I can actually execute for $0 in commission, very small management fees, fractions of a percent on a yearly basis. The most efficiently managed of these funds, we're talking about 0.1% or 0.2% management fee. No loads, none of that. So extraordinarily efficient. And this dashed line shows you the number of firms, a number of these actively managed equity funds that actually beat that Vanguard 500 portfolio. And you'll see a lot of volatility in here. So, from year to year, there's quite a bit of volatility. So let's look at this on a different basis. Let's look at funds existing for the past 10 years. So now we're getting what we call a survivorship bias in here. These are the more successful funds. The funds that were less successful were started and closed inside of this 10-year window. So they don't show up in here. So one could argue that these are the really good funds with very good managers that know what they're doing. So that's the dark red line. That's the number of them. And then the dashed red line is those that actually beat this Vanguard 500 index. Kind of incredible, right? I mean, look at here. We've got a little more than 500 out of the, somewhere in the 1,300 range of funds. So a third of them actually beat a buy and hold strategy. Yet we're spending millions and millions of dollars compensating these managers with millions of dollars. And they have huge management fees. I'm not sure whether this graph actually factors out the management fees or not. If it doesn't, that number that beat the S&P actually drops even further. It's pretty compelling data, Yeah, you could argue, are we risk adjusting? Well, no, we're not, because we're comparing this to a broad-based index which has the risk of the market, and these fund managers might have portfolios that are much riskier. So we're actually biasing against finding a result here, more than likely. If we look at it on a year-by-year basis again, and actually calculate the percent that beat the Vanguard on a year-by-year basis, it's just another way of viewing this graph, right? This dashed blue line is now on a bar chart. And then again, yet another way of viewing this. If we look at length of investment period of 1 year over the span of 89 to 2018, so we've got 30 years here, the number of investment periods where half of the funds beat the Vanguard, only 12 out of 30 of those years did they beat the Vanguard 500. So 40%. Was there any period of time where 3/4 of them beat it? Nope. 0. Now, if we extend the window to 3 or 5 or 10 years, the numbers go up, and we have a few periods where 3/4 of them actually beat it. But again, remember, these are the managers that have survived and are supposedly the best of the best. Yet still, that looks pretty much like a coin flip to me. And like I said earlier, if I'm not backing out management fees, I'm not capturing the full picture of this, and those numbers will get worse. So I'm biasing against this if they don't factor out the management fees. I'm biasing against finding more firms. So raises some real serious questions here. Performance of professional money managers is especially troublesome when we consider how many resources they have. They get the best and the brightest because they pay huge salaries. So if you were interested in physics or math or any other science endeavor where it's very quantitatively oriented, a lot of physicists become financial economists and quants. A lot of mathematicians do the same thing. Why? Because that's where the jobs are. That's where there's a lot of money. So we've got managers who, even with that, the best and the brightest, as much computing power as you could possibly want, they still have a difficult time beating the market. So what is the role for portfolio managers in an efficient market? I always like to think about this. If we had no active management, if we had no analysis, then a small amount of analysis and active management would be very valuable because prices would be completely inefficient. So I think we're talking about, coming up with some optimal level. It's not that we don't need any active management, because if we didn't have it, by definition, the prices would no longer reflect the information. If nobody was analyzing it, if nobody was making trades based upon information, it can't get into the price. So the question really is more at the margin, right? How many is too many? Do we have too many now? More than likely, I think the answer is yes. How many too many? That's a difficult question to answer. So another thing, though, that active managers can do is create portfolios for particular groups of individuals. And the example that they give here, suppose that you're an employee of Starbucks, and Starbucks gives you the opportunity to either buy stock at a reduced price, or maybe even part of your compensation is shares of Starbucks. And as a result, you're overexposed to that sector, that industry, that particular company. So when you go to invest, you don't want a portfolio that adds to that. You want a portfolio that actually has a reduced level or no exposure to that particular industry, and especially to Starbucks itself. So we can certainly see a very viable role for portfolio managers in creating these various portfolios for particular subgroups of the population. We already looked at the fooled by randomness. So now we move into talking a little bit about some of the anomalies that have been discovered. And believe me, there are dozens and dozens additional anomalies that weren't mentioned by your authors. But these are some of the better known puzzles, and some of them still remain to this day puzzles. So a market anomaly is something that deviates from market efficiency. Yet we observe this feature in the prices and the returns. So the day of the week effect has been documented for decades. And the day of the week effect is that essentially Mondays tend to have a negative average return. So what? And look, what are we talking about? 14 basis points here? So what? If I could get 14 basis points on something, I'd love it. 14 basis points times $1 billion? It's a lot of money. So yeah, actually, this is meaningful. But is there some way to capitalize on this? Well, it doesn't look good when we look at the more recent data, right? In the 50s up through the 80s, yeah, there seemed to be something there. But when we look from the 80s on up to today, ooh, that sort of disappeared. So yeah, this day of the week effect doesn't seem to actually have much bearing on us today. This is something that we see repeated over and over in this study of anomalies. An anomaly is discovered by some researcher or some practitioner, and then it gets some publicity. And then we look at it later on down the line, 10, 15, 20 years later, and it seems to have gone away. So even if it was a thing at one point in time, even if it was a deviation from market efficiency, by uncovering it and publicizing it, traders have taken advantage of that and driven it out. So that's an okay thing, right? That's what we want to see. And that's why, researchers and practitioners are constantly looking for other anomalies. Why was there a Monday anomaly? Could it have been a statistical aberration? Yeah, that's a possibility. Could it be that when it was discovered, participants took advantage of it? So what would I do if I knew that there was a negative return on Mondays? What sort of strategy could you imagine implementing? How would you, in other words, how would you capitalize on that knowledge? Let's say that we're standing back here in the 60s or 70s, and you knew that there was on average, a negative 0.14% return. Tony?
Did you buy on Mondays?
Yeah, you could wait till the close, right? Yeah, buy at the close. If you let's say that, let's say we're not even doing a pure arbitrage. In other words, a round trip. Let's say we're quasi arbs. In other words, we have already decided to take a long position in the market. When would you buy? And the answer is exactly that. You would buy Monday at the close, because I'm not going to buy Friday at the close, because that's an up day. But if I was going to be long, and it didn't matter whether I bought, on Friday or Monday, my preference would be buy on Monday. So a lot of people engaging in that same strategy could make this thing go away. So if a lot of us bought on Monday, that would actually drive up the price on Monday, and that would drive away that negative average return on Mondays. And that could be why that we now see nothing in the more recent few decades. All right, so that's day of the week. There's the January effect. This is actually something that my dissertation chair, Ed Dill, was instrumental in uncovering and publicizing the January effect. So the January effect is the tendency for small cap stocks to have large returns in January. Now, this chart that you're looking at here is not small cap stocks. This is the S&P on a monthly basis from 1926 to 2018. By the way, just a interesting anecdote. You'll see some of these dates over and over. 1926 is one of those dates. 1962 is another one of those dates. This is when some of the data began to become available. The CRISP database, the Center for Research into Securities Prices at Chicago, CRSP, otherwise known as CRISP. That database became available in 1962. I think it was July 4th or July 1 on 1962. So you see a lot of these dates over and over again because that's when data became available. There's nothing unique about that particular date. But if we look at these returns on a monthly basis for the S&P 500, and in particular look at January, and you go, well, there's nothing remarkable about January. Now go to the small caps and look at January. Oh, yeah, something remarkable there. Almost 6%, when a normal month is, hovering around 1-ish. A couple of months here, October surprise, that probably drives that one. But look at that January effect. That's amazing. We still don't really know why that's the case, but it's there. Can you capitalize on it? That's a different question. It's a much tougher question. And remember, these are small cap stocks. So is it worth it to even capitalize on it for the big funds, for the active managers who are moving billions of dollars around? And the answer is maybe not. For a small investor, maybe so. I'm not suggesting you go out and do this tomorrow. What I am suggesting, though, if you do the research, maybe there's something still to be gained in that effect. That's a pretty significant. We're not talking about a few basis points here. We're talking about hundreds of basis points difference.
I have a quick question on that.
Oh, yeah, go ahead, Zach.
Since it's such a long time frame, is that still kind of holding true today, or is it stronger? Is it weaker? Do you know?
Off the top of my head, I can't tell you whether it's stronger or weaker, but that's an excellent question. And let me jot it down and see if I can't find that answer. I'm sure there are some studies that people have looked at. I haven't seen any recently, but I'll look into that. That's definitely relevant, though. Did it actually go away? That if it didn't go away, that might tell us something else. It might tell us that maybe this is either just some weird artifact, and that's unlikely, but I think the other case is maybe it's very difficult for that to go away. One of the theories behind why this is the case is that there is a tax loss selling argument for that. So the argument goes like this, that portfolio managers that hold these companies, for the companies that did very poorly over the prior year, they're going to sell those to take the tax loss to offset their gains so that they don't have a taxable event. And as a result, they get rid of them at the end of the year, and then they turn around and they buy them back at the beginning of the year, and that causes an increase in price. Now, you would expect a much more severe decline in price in December if that was the case in all of these. But that's one of the theories out there as to why this effect is out there, and maybe that's why it persists too. But I'll look into that. Are there any other questions so far? Turn of the month. So we've got turn of the week, day of the week. We've got day of the month. We've got turn of the year. All of those effects. In fact, again, some of the anomalies they don't point out. There's a momentum strategies when you look at 2-year holding periods, 3-year holding periods, 5-year holding periods. And there are some reversals on that as well. All of that is documented in some of the more famous studies of these anomalies. But here, this turn of the month, at the turn of the month, and that's a few days around the end of one month and the beginning of the next, we see returns on this order, and these are abnormal returns. And the rest of the days, much, much lower. And again, there are some explanations for why this might exist, so maybe it still goes on, and there really is no way to capitalize on it, but it's an anomaly. Bubbles and crashes are other examples of what some argue are deviations from market efficiency. And I say some and underline some because there are some quite famous contrarians to that group, and people like Gene Fama at the University of Chicago, Nobel Prize winning financial economist, probably has the record for or at least is close to having the record for the most publications in the top 3 journals in the field. Just a very bright researcher and student of finance and investments. He argues that there is no such thing as a bubble market or a crash. He argues that it's a factor that we're missing in the models. It looks like a crash, it looks like a bubble, but it's simply because we're overlooking a very important factor that relates to the pricing of that security or that group of securities. Many of us, though, in the profession say, well, yeah, Gene, you got a point, but, what would that factor be? Tell us what it is, and we'll go out and we'll look at it. And Gene can't come up with a factor. So many of us believe that bubble markets are some sort of overestimation of the future prospects or some market inefficiency. So this could be a behavioral characteristic. It could be that we all become overly optimistic about the outcome of the market and we bid up the prices. And then all of a sudden there's usually one trigger and we all go, oh, wake up. They're not really that valuable, and the market crashes. And then we come back to some equilibrium that is more or less efficient. So these bubble markets have occurred over and over again. One of the more famous bubble markets of history is the tulip market in the Netherlands. So that's kind of where this history of bubble markets begins, hundreds of years ago. And we've seen examples of this over and over again in our recent history, the past 50 to 100 years as well. And then usually correlated with bubble markets are crashes that make some sort of correction for that bubble market. So crash of 29, we had a bubble in the 20s, the roaring 20s. Everybody was optimistic. We were able to leverage our margin positions up to we could have a 10% margin. So we could borrow up to 90% of the money. And so wouldn't that necessarily bid up stock prices? Sure. In fact, even today, look at how much stimulus has been pushed into the economy. And I'm not arguing against stimulus by any means. But if you add it up over the pandemic, we're talking on the order of close to $6 trillion. So is it any surprise that the market has reached all-time highs with that kind of extra money floating around? I mean, the government is effectively printing money. Now, for some reason, it has not yet caused any sort of inflationary action in the marketplace. There's some mild whisperings of inflation, but nothing that is even remotely related to high inflation at all. So you even wonder about today's market. A lot of people are questioning whether the market is in some sort of bubble and will there be a correction of some sort. And so the 20s were certainly one, but up until 1987, 1929 was thought of as, one of the worst occurrences. Well, in 1987, on Friday, October 16th, the Dow fell 108 points. And people thought, not good. Why 108 points? Well, remember, it was only down around 2,000 at that point in time. So 100 points was a big move. Today, with the Dow over 30,000, 100 points is nothing. I mean, they shouldn't even report anything less than 200 or 300 points because it's meaningless. It's just noise in the process. But the following Monday, lost 22.6% of its value. Stunning. I mean, never prior to that had the market lost that much in a single day. It just freaked a bunch of people out. So it lost 508 points to close at 1738. Now, again, the aftermath. Here we were. Here was Monday. But look at what happened afterwards. Market climbed back up. And so, a couple of years later, October 87 to October 89, had you not sold down here, in 2 years you would have recovered your value. So the other thing about bubbles and crashes that we can observe this in the data is that while they feel like the world is ending, we should probably try to temper ourselves and disconnect from that emotional response and say, yeah, I'm going to look at this as a buying opportunity. Oh, I didn't realize the time. I apologize. We're at 1:47. Let's stop on this right here. We'll pick up on circuit breakers on Thursday. And then on Thursday, we'll also get into Chapter 8, which is behavioral. In that chapter, I've got a few more exercises. So if you would, when you come to class, make sure that you've got a piece of scratch paper and a pencil, and then it wouldn't even hurt to have a calculator. Nothing, heavy-duty calculations that I need you to do, but it wouldn't hurt to have that, especially in a couple of these probability exercises that I'm going to give you. But we'll have a little bit more fun than typical lecture. Hopefully it'll be a little more interactive. We're going to look at some of the behavioral aspects that might affect the efficiency of a market as well. So any other questions before we wrap things up? I will see you all on Thursday. Have a good couple of days. Bye-bye.